Management wants you to celebrate a record $2.93 billion profit, but they quietly buried a permanent $400 million tax hit and a 210 basis point gap in their regulatory capital. For anyone relying on these banking dividends to fund retirement from CPF or SRS, this underlying margin decay is the silent killer of future payouts. Today, we strip away the headline fluff to reveal exactly why the core lending engine of Singapore's largest bank is flashing a warning sign. I have been watching this one for a while. The gap between management's optimistic framing and the market's cold interpretation is exactly why we do these audits. When the net interest margin collapses by 23 basis points, you have to run the numbers twice, because the era of interest rate-driven profit expansion has effectively ended. Management wants you to celebrate a record $2.93 billion profit, but they quietly buried a permanent $400 million tax hit and a 210 basis point gap in their regulatory capital. For anyone relying on these banking dividends to fund retirement from CPF or SRS, this underlying margin decay is the silent killer of future payouts. Today, we strip away the headline fluff to reveal exactly why the core lending engine of Singapore's largest bank is flashing a warning sign. Looking at the immediate market response to the first quarter earnings release, the headline profit figures were a record, but the technical weakness in the margin trajectory was hard to ignore. The stock opened at $58, a 2.55% gap up. It then quickly tested significant support levels intraday at $57.80. Trading volume exploded to 8.05 million shares, a massive 34% spike above the 30-day average. Management pointed to record total income, a 17% return on equity, and net profit up 1% year-on-year to $2.93 billion. The market looked straight past all of that and focused on one number, the net interest margin, which has now dropped to 1.89%. From 2.12% a year ago. That 23 basis point collapse tells you the rate-driven profit expansion era is effectively over. When management and the market are reading the same report and arriving at completely different conclusions, that is exactly when you need a forensic lens. What is truly revealing is the institutional sentiment shift. We saw net outflows of $79 million in the final week of April. Short interest rose 10.43% heading into the reporting date. That is a distribution phase. Large-scale holders appear to be trimming into the record profit news, leaving minimal margin for error at the current premium valuation. We process the earnings report strictly by the numbers. For the banking sector, we lead with the two metrics that matter most. The net interest margin tells us how much the bank earns on lending. The Common Equity Tier 1 ratio acts as the core emergency capital buffer, the money in the biscuit tin that absorbs the shock before your dividends get cut. Every other metric is secondary. Right now, the net interest margin has collapsed. That requires our full 5-layer forensic treatment. Starting with the raw fact, group net interest margin has declined to 1.89%. The historical benchmark reveals severe deterioration. That is a 23 basis point collapse year-on-year from the 2.12% recorded a year ago. The peer context is damning. OCBC maintains a higher Common Equity Tier 1 safety buffer at 17% in this exact same macroeconomic environment. The forward scenario is grim. If benchmark rates drop another 10%, compressing the margin below 1.75%, the $16 million net interest income loss per basis point will completely wipe out recent wealth management gains. And here is what that means for you specifically. For a 55-year-old holding this stock in a CPF Investment Scheme account, this margin squeeze means future dividend growth is effectively capped. The bank is running on a treadmill just to maintain current payouts. Now to the capital buffers. The Common Equity Tier 1 gap is the number management does not want you to read twice. The presentation highlights a transitional ratio of 16.9%, projecting a fortress balance sheet. But dig into the footnotes. The fully phased-in ratio is actually 14.8%. That is a 210 basis point gap, $7.8 billion in capital, that exists on paper today but disappears when full regulatory phase-in arrives. That leaves the bank only 30 basis points above its lower bound regulatory target of 14.5%. For a heartland investor counting on dividend continuity, this is the single number worth revisiting every quarter. The actual margin of safety is significantly thinner than the press release implies. There are hidden risks buried deeper still. Management reported 1% year-on-year net profit growth, completely excluding the $400 million increase in tax expenses from the 15% global minimum tax under Pillar 2. If tax rates had remained constant, net profit would have grown by nearly 15%. That $400 million hit is a permanent structural drag on the bottom line. On top of that, specific allowances for Stage 3 bad loans rose 31% year-on-year to $157 million. The record total income headline is heavily propped up by a $19 million markets trading net interest income figure, which has historically been a massive drag in prior cycles. The headline numbers are wearing makeup. Management is masking structural decay with treasury activity. Turning to the institutional view, the sell-side analyst community remains broadly supportive with a consensus buy rating, but the price targets are heavily diverging. DBS Vickers upgraded their target to $60. Macquarie maintained a sell with a target of $48.67. UOB Kay Hian cut to $66.75. Goldman Sachs trimmed to $66.50. That spread in expectations highlights the uncertainty around whether wealth management fee income can permanently replace the net interest income loss. The market is split between those buying the wealth transformation story and those looking strictly at the deteriorating loan margins. On valuation, the current pricing reflects a perfection premium. The stock trades at a price-to-earnings ratio of 15.3 times and a price-to-book ratio of 2.41 times. That sits significantly above its 3-year historical average of 1.8 times book and well past the sector benchmark of 1.5 times. This price-to-book ratio sits in the 85th to 90th historical percentile. Future capital appreciation depends entirely on further return on equity expansion, which is currently facing severe margin headwinds. You are essentially paying peak prices for a bank entering a rate cut cycle. There is no margin for error if the global macro environment softens. We run the yield spread to determine if the risk justifies the entry. The current dividend yield sits at 6.25%. What the yield spread confirms independently is that this yield clears the absolute Iggy forensic floor of 3.2% by 305 basis points. It also clears the 4.7% minimum yield hurdle with a healthy 155 basis point margin. The income case is not wrong, but the underlying capital risk must be weighed against that payout before making any move. Mapping onto the forensic matrix, the stock passes the absolute yield hurdle. Income exceeds the 4.7% threshold, but caution is heavily stressed on payout sustainability. The high payout pressure pushes this into the upper right quadrant of our risk map. The margin compression we identified directly threatens the bank's ability to maintain these payouts without dipping into core capital if the wealth management fees falter. For a retail investor, this means you are getting paid today, but the safety net underneath that payment is getting thinner with every quarter of rate cuts. This is no longer a low-risk conservative payout play. It requires active monitoring of the macroeconomic triggers that affect lending margins. On the specific scorecards, the forensic verdict beats expectations on current income, but shows real fraying at the edges. On the income sustainability scorecard, the payout ratio fails our safety threshold. At 74.6%, the bank is distributing a structurally high share of earnings, leaving limited buffer if earnings compress. On the debt health scorecard, gearing sits safely at 5.9%. Retirement capital is not at risk of an immediate liquidity crunch today, but the nearest debt maturity in 2027 is an active flag. Refinancing exposure has moved from medium to high. That is a deterioration that needs monitoring every single quarter through 2026. This is exactly why you should not be reading these earnings reports alone. The difference between a sanctuary asset and a yield trap is often decided in a single trading session. If you want the full forensic picture before the market opens, Iggy's elite investors get 0-day access to these breakdowns, complete with the red zone watchlist and 5-layer cheat sheets. The link is in the description. Projecting this forward, we track 3 distinct scenarios. In the bear case, geopolitical escalation disrupts trade. The net interest margin drops below 1.75% rapidly and a dividend freeze or minor cut follows. The base case assumes gradual rate normalization offset by wealth management fees, resulting in flat net interest income growth and a stable 81-cent quarterly dividend. The bull case requires wealth management assets under management to grow more than 15% year-on-year, fully replacing the interest income loss and potentially resuming special dividends. Watch the macroeconomic triggers closely. They will tell you which path we are walking down. And here is what this means for your wallet. The $16 million net interest income sensitivity for every 1 basis point drop in benchmark rates creates a structural earnings hole. Management is betting that a record $907 million in wealth management fees can plug it. Those fees are real, but relying on market exuberance to cover a structural lending deficit is a dangerous game. If the net interest margin falls below 1.75% from the current 1.89% and wealth growth stalls below 5%, the 81-cent quarterly dividend becomes unsustainable from current earnings alone. Comparing the two giants head-to-head, On the metric that matters most for a heartland income investor, the First Bank offers a higher dividend yield at 6.25% versus 4.3% for the second. Despite the high price-to-book valuation, the first generates a 17% return on equity that allows it to maintain that yield while retaining earnings for growth. The second bank's 12.6% return on equity provides a thinner margin for future payout expansion. But the second bank wins on safety, holding a fully phased-in Common Equity Tier 1 ratio of 17%, compared to 14.8%. The choice between them comes down to exactly what kind of risk you are willing to take. You are paying for that higher yield by sacrificing capital safety headroom. The $50,000 impact calculation tells the story a profit headline cannot. At $58.53 per share, $50,000 buys 854 shares. Your annual income increase year on year is just $61.92, barely a month of utility bills for a Marine Parade retiree. Factor in inflation and the real purchasing power gain is effectively zero. Management earns a passing grade for agility using wealth fees to save the quarter, but they fail the strict predictability test. You are absorbing the risk of a peak valuation entry just to tread water on your yield curve. Bringing this together for the forensic stance, this is a firm watchlist trigger. The active thesis regarding strategic exhaustion is debunked. The record wealth management fee income demonstrates that the pivot away from interest rate dependency is generating tangible cash flow. But the 2027 debt wall thesis is fully confirmed. Sequential margin compression validates the risk of structural earnings decay through 2027. The single most important takeaway from this audit is this: the bank is functioning as a wealth management powerhouse, but its core identity as a traditional lending institution is structurally shrinking under the weight of margin compression and permanent new global taxes. The fundamental question is whether you are prepared to hold a bank at peak historical valuations when its primary compounding engine is mathematically engineered to slow down over the next 24 months. The record profit is real, but the benefit flowing through to your actual retirement income requires you to absorb an outsized amount of capital risk. This is exactly why you should not be reading these earnings reports alone. The difference between a sanctuary asset and a yield trap is often decided in a single trading session. If you want the full forensic picture before the market opens, Iggy's elite investors get zero-day access to these breakdowns, complete with the red zone watch list and 5-layer cheat sheets. It is less than the price of a coffee and kaya toast at Raffles Place, and the link to access these institutional-grade audit tools is right down in the description. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get zero-day access, link in the description. Bringing this together for the forensic stance, this is a firm watchlist trigger. The active thesis regarding strategic exhaustion is debunked. The record wealth management fee income demonstrates that the pivot away from interest rate dependency is generating tangible cash flow. But the 2027 debt wall thesis is fully confirmed. Sequential margin compression validates the risk of structural earnings decay through 2027. The single most important takeaway from this audit is this: the bank is functioning as a wealth management powerhouse, but its core identity as a traditional lending institution is structurally shrinking under the weight of margin compression and permanent new global taxes. The fundamental question is whether you are prepared to hold a bank at peak historical valuations when its primary compounding engine is mathematically engineered to slow down over the next 24 months. The record profit is real, but the benefit flowing through to your actual retirement income requires you to absorb an outsized amount of capital risk. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.